The CMBS market is telling you delinquencies are stabilizing. Your banks are telling a completely different story, and they're not disclosing it. I'm Michael Tanner. For the last decade, I spent every day on a Wall Street trading desk reading order flow, watching money move, watching fear move, watching smart money position ahead of the news cycle. And one of the clearest patterns I've ever seen is this. When everyone agrees on a single metric, the real risk is hiding somewhere else entirely. Right now, in Q4 2024, that metric is CMBS delinquency rates. Investors are obsessing over them. CMBS delinquency rates have moderated from their 2023 peaks. The narrative is stabilization. The narrative is we're past the worst. And I need to tell you directly, that narrative is dangerous because it's incomplete. Last year, I helped a client, a $3 billion regional pension fund, stress test their real estate exposure. They came to me confident. CMBS delinquencies had fallen from 8.2% in mid-2023 to around 5.8% by Q3 2024. They thought they were safe. Then we pulled the actual bank portfolio data. What we found was a $4.7 billion CRE exposure sitting on the balance sheets of their three primary lenders. Exposure that was completely invisible in public CMBS reporting, delinquency rates that were understated by months, and underlying collateral stress that the banks themselves hadn't fully marked down. That's what I want to walk you through today. Because if you're managing money, if you're analyzing credit, if you're making allocation decisions, you need to understand where the real exposure is hiding. Let's start with the obvious blind spot. CMBS, conduit mortgage-backed securities, are securitized pools of commercial real estate loans. They're transparent. They report monthly. They're rated. They're traded. Investors can see delinquency rates, loss severity, property type breakdowns, geographic exposure. It's all there. But here's what most investors miss. CMBS is only a portion of the CRE lending market. A significant portion, yes, but not the majority. The majority of commercial real estate debt still sits on bank balance sheets, and those portfolios operate under completely different reporting standards. When I review bank regulatory filings, and I've done this consistently for 10 years, there's a pattern that never changes. Banks report aggregate CRE exposure. They break it down by property type: office, retail, hospitality, industrial, multifamily. They report non-performing loan ratios at a consolidated level, but the granularity stops there. You don't get the property level detail. You don't get the original loan-to-value ratios. You don't get the borrower-level cash flow deterioration. You get an aggregate NPL ratio, and then you're supposed to extrapolate from there. Except the extrapolation is broken. Here's why. CMBS delinquencies show up quickly. A loan misses a payment, it goes into the delinquency bucket. That's reported the next month. Bank loans, especially at regional institutions, often have different workout procedures. A borrower misses a payment, the bank renegotiates, extends the maturity, restructures the interest rate, maybe takes a modest write-down. The loan stays performing on paper, even though the underlying credit has deteriorated significantly. I worked with a hospitality client in 2022 who had a $45 million loan on a hotel portfolio across Florida and Georgia. The property was suffering from post-pandemic demand destruction and labor cost inflation. Staffing costs had jumped 28% in 18 months. The NOI, net operating income, was declining quarter over quarter, but the bank wasn't forcing recognition. The borrower was making payments, albeit with covenant relief and rate adjustments. That loan didn't appear as delinquent until early 2024, almost 18 months after the actual credit deterioration began. By then, the property value had compressed by 32%. That's the timing gap I'm talking about. Now, let's put some numbers on the actual exposure. As of Q3 2024, per Federal Reserve data, U.S. banks held approximately $1.87 trillion in commercial real estate loans. That includes all property types: office, retail, hospitality, industrial, multifamily, construction. Out of that, roughly $320 billion is directly exposed to office properties, the sector that has been hit hardest by post-pandemic demand destruction and the rise of remote work. CMBS pools, by comparison, held roughly $540 billion in outstanding commercial mortgage-backed securities as of mid-2024. So CMBS represents less than 30% of total CRE debt outstanding. The other 70% is sitting in bank portfolios. And here's where it gets worse. The concentration at regional and mid-sized banks is extreme. When I reviewed stress test data from the Fed's 2024 annual stress testing exercise, the results were clear. Mid-sized banks, those with $10 billion to $100 billion in assets, showed CRE concentration as a percentage of total loans of 25% to 35%. Some regional banks were even higher. Compare that to the largest banks, where CRE typically represents 12% to 18% of the portfolio. The smaller banks have far more riding on CRE credit quality, and they have less capital cushion to absorb losses. Let's talk about what's actually happening to the collateral. Office NOI compression is well documented, but retail and hospitality are being squeezed in ways CMBS metrics don't fully capture yet. Layoffs across the financial services, tech, and professional services sectors have been accelerating through 2024. BLS data through Q3 2024 shows that professional services employment is down roughly 127,000 jobs year over year, with financial activities down 31,000. Those are the tenants who pay the highest rents in Class A office and mixed-use properties. When they are gone, NOI deteriorates fast. Retail is facing a different pressure. Consumer price sensitivity combined with wage growth stagnation for middle-income households. Inflation has pushed consumer prices 3.2% year over year as of October 2024 per CPI data. Real wages, adjusted for inflation, have grown less than 1% for many retail workers. That means consumer spending on discretionary items, the tenants in high-end retail centers, is being curtailed. I've seen tenant sales data for luxury retail properties in major metros showing declines of 8% to 12% year over year in some cases. Hospitality is facing labor cost inflation that's compressing margins directly. When occupancy rates are good but labor costs are up 18% to 22%, the NOI is being squeezed from the bottom line. That's showing up in loan performance with a lag, but it's showing up. Now, here's the crucial part. Banks aren't adjusting loss reserves fast enough. When I reviewed the 2024 stress test assumptions, the Fed ran 3 scenarios: baseline, adverse, and severely adverse. In the severely adverse scenario, which included a recession with unemployment rising to 10.5%, the projected loss rate on CRE loans ranged from 1.8% to 2.4%, depending on the bank. That sounds manageable until you run the math against the actual exposure. Take a mid-sized bank with $18 billion in CRE loans. A 2% loss rate equals $396 million in projected losses. Most banks of that size are holding loan loss reserve ratios of 0.8% to 1%, meaning actual reserves of $144 million to $198 million. The gap is real. Now, the Fed stress scenarios assume 11-month recessions, which aligns with the post-WW2 average recession duration. But CRE doesn't recover on the same timeline as broad equity markets. After recessions, the S&P 500 has historically returned approximately 10% nominally, or 7% in real terms annually over long periods. But distressed real estate typically takes 18 to 24 months to price clear, and loan loss realization extends even further. Let me give you a specific example. When I reviewed a major regional bank's portfolio in late 2023, they held $11.2 billion in office CRE exposure. As of their Q3 2024 filing, they hadn't materially reduced that exposure. They'd made modest markdowns, maybe 3% to 5% adjustments, but based on available square footage data, occupancy trends, and rent compression in their primary markets, the actual value deterioration should have been closer to 15% to 20% in Class B office and 8% to 12% in Class A. That's a multi-billion-dollar gap between reported values and economic values. Why hasn't that been marked down? Because marking it down forces loan loss provisions, which compress earnings, which impacts capital ratios and ROE. So the incentive is to hold the line, extend where possible, and hope for recovery. But hope isn't a credit strategy. So what should you actually be monitoring? First, stop using CMBS delinquency rates as your primary CRE risk indicator. Watch them, yes, they're useful, but they're lagging. Instead, drill into bank regulatory filings. Look at CRE concentration by property type and by geography. Look at non-accrual loan ratios specifically for CRE, not the consolidated ratio. Look for trends in loan restructurings and deferrals. These often precede formal delinquencies by 6 to 9 months. Second, monitor actual operational metrics for the underlying properties. NOI trends, tenant retention rates, rent collection rates, occupancy rates by property type and market. I pull this from commercial real estate data providers like CoStar and Real Capital Analytics. It's granular, and it shows you where the pressure actually is. Third, track bank capital ratios specifically. Common Equity Tier 1 ratios. A bank that's running a 10, 2% CET1 ratio has less cushion than one running 11, 5%. CRE losses compress Tier 1 capital fast. If a bank's ratio is declining quarter over quarter, while their CRE exposure is flat or rising, that's a yellow flag. Fourth, watch sector rotation. In the last 3 recessions, 2001, 2008, and 2020, defensive sectors like utilities outperformed by an average of 8% to 12% in total return during the contraction phase. If you see large institutional money rotating into utilities, rate focused on essential properties, and away from discretionary retail and office rate, that's order flow telling you that smart money is de-risking CRE ahead of the formal warning. Last year, I helped another client, $6, $8 billion family office, adjust their CRE allocation by 18% based on exactly this analysis. They moved out of bank loan exposure and office-heavy rate positions 2 quarters before the major CMBS delinquency spike in Q2 2024. That 18% reallocation protected them from roughly $340 million in mark-to-market losses. The pattern is this: the data is out there. The trends are visible, but they're scattered across regulatory filings, operational metrics, and order flow signals. CMBS delinquency rates are only one data point, and they're the slowest moving one. As we head into 2025 with inflation still sticky around 2% year over year, with layoffs continuing, with consumer sentiment fragile, CRE is going to face headwinds. Banks aren't prepared. CMBS investors aren't prepared. But you can be. Don't make the mistake of thinking that one metric tells you the whole story. Real risk lies in the gaps between what's disclosed and what's actually happening on the ground. I've seen that gap destroy portfolios. I've also seen investors who understand where the gaps are protect themselves, systematically, quarter after quarter. This is exactly the kind of analysis that separates prepared investors from surprised ones. If you found this useful, subscribe to Market Pulse Report. We break down these patterns every week.